Well, and you guys, we're just excited to have everybody that's joined us tonight. The fact that you're taking time out of your evening to join us to talk about some riveting topics, right? Financial planning is usually not one that always makes the top peg, but it's questions that everybody ends up having. Felt like before we get going, Zach, I wanted to just so you can see a visual. I'm the type of person that likes to be able to see the face to the person that's speaking. And so given that, I feel like we should just have you guys kind of introduce yourself. Just a second though. Tyson?
Yeah, I'll go first. Tyson Long, relatively new to the Capita team, but super excited to be here and looking forward to covering charitable giving with you guys. You guys have some great speakers here too.
He's getting paid to say all of this, by the way. It's literally,
he's not only getting paid to be here as well, right?
Yeah, it gets paid to be here and to say that. That's great, Tyson. Thank you.
I'm a good soldier.
Like we practiced.
Am I next?
Yeah, go ahead.
Okay, Tyler Williamson. I'll be discussing Social Security strategies, and I've been with Capita for 9 years.
From the beginning, pretty much from the beginning.
From the roots.
He was part of Mike's origin story.
That's right.
It's not going to be a movie.
All right, I'm in the back, and I'll be running technology today and asking a couple questions for gift cards. And I'm actually really happy to be in that spot. I don't normally have this role. It's exciting. I've been with Capita since 2015. I came after Tyler. I don't know, great place to be. Best decision career-wise that I made.
My name's Laura Hadley. I've been with Capita almost 4 years, and today I'm going to be talking all about Roth.
Laura is also a co-host with me on the Financial Call podcast. So Laura has really jumped in as one of our main educators at Capita. And it's been a really good deal. I mean, I think she has a way of, you'll see, but she has a way of bringing this to a level that we can all take very complex topics and actually act on them. So it's been really good to have Laura added to that.
Thanks for setting the bar high.
Yeah, exactly. It better
no
be
pressure.
good, Laura. No pressure.
And lastly, you guys, I'm going to kind of MC for the evening here, which means I'll probably not say a ton. Just mainly introduce Matt Johns. I'm another advisor here at Capita. I've been here for about 3 years. The part that's so neat about being a part of these events is I feel like when we do it all in the same room like this, you get a chance to be able to see the interactions with us as advisors. All of us that work here love what we do. We're truly passionate about the craft of financial planning, and we're hoping to share some of the tidbits of that with you this evening. We're going to start with Tyson, and then we'll transition to Laura and to Tyler. And to keep you interested, we will do some giveaways. So, Tyson, let's talk charitable giving.
Yeah, Zach, did you want to do a question first?
Oh,
yeah, that's true. See, I've already dropped the ball on this. Okay, here it is. This is our first question. We're going to figure out and test the poll. So the question is, how many employees does Capita currently have? Now, when we asked this question, the poll's not up yet. Don't guess in the chat. Don't guess in the chat. Not yet. It's coming. It's coming. You're going to see it pop up. It'll be 5 options you can choose from. When we made this poll, we actually didn't have one of the employees, but we knew we were going to hire them. So we upped the number by 1. That's how much it's grown. Okay, so here we go. Let me know if this works. We will see. We'll start to see you guys answer. Oh, nice. Okay, so we're up to about 30 responses, 40, 50 responses. Okay, everybody's answered. Let's show you how this looks. Can y'all see that? Now, everybody in the room, I'm going to put it up here for you. And the answer, let me get back to here. Tricky. Or tech support. Where is tech support when you need them, right? All right. The answer is 31. Capita has 31 employees. So while you guys are chatting here, I'm going to figure this out. In fact, actually, let's just try to figure this out quick. I have to download these results, and we're
go ahead and download those. Did you guys notice how classic those answers were, though? Like, it's a multiple choice. The A was really undershot. I mean, you got 5 of us here. There's probably a high probability
Pick the one
of that one. And then
There's
the other
5.
one,
That's
what was the last one?
C's always the right answer, though, right?
She's not wrong.
This is D. D was the right answer.
Oh, I thought it was C.
No, there was an E.
Tyler, how'd you do
Oh, there
C?
was an E?
How did the ACT go for you, Tyler?
I passed.
Is that how that test
No,
worked?
that's not how that
I just,
So the last answer was what, 54?
Yeah. It was 15, 21, 27, 31, and 54. And this
Okay.
is making me download an Excel file. We are so
Wow.
close, people. But the first response,
Drum
I
roll,
gotta
drum
make
roll.
sure that
Yeah,
I
here it goes.
don't.
There were a lot of
Matt,
people that guessed
Order
it
did this
correctly.
go in? You know what?
40%.
Give me a second. here,
Matt,
'cause
you're the MC. You got to give us
Yeah,
a
here we
drum
go.
roll
Come
or
on, guys. Just
At least,
it's like, what is it?
entertain
Christmas
everyone for a
vacation,
minute.
right? Don't they do that when he's getting his
Pauline.
bonus?
Pauline.
Pauline,
Roylance?
congratulations.
Is that how you say her name? I don't know Pauline. Pauline Roylance?
Yeah.
Okay. Yeah.
She's a good one.
Pauline won.
Great
Okay.
job, Pauline.
Nice job,
I think
Pauline.
Lois deserves a shout out for getting so many songs right at the beginning too.
That's true.
And her last name's long. So
That's
hello,
true.
relative.
I know Lois. Oh, that's right.
Hello,
Yeah, Lois, you don't
relative.
know Tyson's last name is long. Okay, so we're off. Let's get into the real stuff here, Tyson. Go ahead.
All right, here we go. So I'm going to cover charitable giving. This is a topic I'm super passionate about. We've got a lot of other good content today. So some of this might go a little fast, but as always, if you have questions, we're here to help and answer any questions you have after this. A couple quick things. So anytime we talk charitable giving, I like to make sure it's clear, like by no means are we trying to encourage somebody to be charitable if they're not already. These are all strategies to help you do whatever you're interested in and what you do charitably right now.
But we
and make
could
it better.
encourage them if we were like,
Hey,
would you not want to be affiliated with somebody that's like
I
trying
just
to
don't
make
want to be, I don't want to put that pressure on it. you know?
valid? Valid.
So,
Yeah.
but I love charitable giving. In fact, two of my favorites, this isn't a sales pitch, but Diaper Bank of Utah is a great one. So I'm going to use that as an example as we go through this. They do a great job helping not just moms, but dads too, parents that need help just getting diapers for their kids. It's a really cool one. So I'll use that as my example. We're going to cover 4 kind of main strategies or concepts: gifting appreciated assets like stocks, bunching strategies, using a donor advised fund, and a very popular one backed by popular request, qualified charitable distributions. Not sure why that says contributions, but
And you made the slide, didn't you?
trying to, I think it was Matt. that
Not
did
sure.
that.
It could have been me. Could have been.
So starting with gifting appreciated assets, this one's pretty straightforward. Oftentimes when we're making a gift to charity, we like to give cash, we write a check, and we make a donation with our bank account. But something to consider too is another really cool strategy is to use any appreciated assets you have, stocks, mutual funds, almost any investment really. I've got an example up here of Apple stock we all are pretty familiar with. You can show there the example. I've got $15,000 of Apple, and let's say that typically in a given year I give $15,000 to charity. In this example, what I could consider here, instead of giving $15,000 of cash, is maybe giving $15,000 worth of my Apple shares, which I only paid $1,000 for because I bought it in like 2007 before the iPhone was big. So I got some pretty good gains on there, and by giving that stock to the charity can sell it and not have to worry about paying any taxes on those $14,000 of gains. But for me, I get a deduction on the $15,000 I gave to the charity, which I would have gotten anyways had I given cash. But I'm also saving taxes on that $14,000 of capital gains.
Hey, I got somebody saying that they can't see the screen. Can other people confirm whether or not they're seeing the screen? You should see a couple boxes with an arrow between them. It'd be good just to clarify. Okay, so yes, it looks like they can see it. Rodney, maybe trying to think about, make sure you don't have 2 monitors. That sometimes happens. Can't think of anything else. Sorry, we're gonna keep going. Hopefully it works out.
Okay, and then just to kind of finish up on this concept a little bit. So really the benefit here is avoiding the capital gains on that 14,000. Just to keep the math simple, I like simple numbers. So if assuming we're paying a 25% tax rate on that $14,000 capital gains, and I've saved $3,500 in taxes that I wouldn't have had I just given cash. Last cool thing I like on this is, if I was going to give cash, I can always take the cash I would have given, and now I can do something else with that. I could spend it. I can even repurchase my Apple shares and have the same 15,000 of Apple because I really love the stock. And it's not a recommendation for Apple. And suddenly I've got the same $15,000 of Apple with a $15,000 cost basis now. So if I ever go sell it in the future, again, my tax bill is a lot lower. So that's the first one.
It's a win-win for both parties, right? For
Yeah.
the individual and then also for the charity,
Yep.
because they're set up to take advantage of this and to incentivize us to give.
I'm
That's
gonna, I'm gonna ask you a question that came through. I know the guy who asked it, and it's a legit question, but do you pay tithing on the $14,000 worth of gain?
That's a personal question. You're gonna have to talk with yourself and your.
Let's get into the
and
window.
leaders.
Let's get into how big you want that window to be open. I just
No comment.
I usually shy away from trying to play bishop for people. I think it's too hard.
Yeah,
He
I'll
baited
pass on
us,
that one.
bait and switch on that one.
But kind of 3 quick bullet points. So again, by gifting appreciated assets directly to the charity in place of cash, we get a tax benefit for the gift, as well as for avoiding capital gains on the sale of the asset. So again, this is to help you get more tax benefits for the giving you're already doing, and also really allows you to give more to the charities you care about. Like Matt said, win-win. Last bullet point, works best with long-term assets that you've held for over a year to get the most tax benefits. And of course, those that have the biggest gains on them.
Tyson, I get this question all the time where people will say, I have stocks in my IRA that have gone up in value. Let's give those stocks to the charity and avoid the capital gain.
Yeah.
It's an IRA. Explain what's going on there.
Yeah, so that's a good point. So this is all assuming that these stocks are not held in an IRA. To Zach's point, if we've got assets in an IRA, if we pull those out, generally we're paying income taxes on all of that when it comes out. We can still give that to the church, but it's not quite the same tax benefit dollar for dollar as this example was, where these stocks are assumed to not be in an IRA account. However, we'll come to one later, the qualified charitable distributions, where you can use your IRA to help with your charitable giving. It's just not the same mechanics as this one.
Perfect.
Fair enough.
Yeah, absolutely.
Oops. So second one, so bunching strategies. Just to describe this really high level, think of this as, if I give $15,000 every year to charity, it's saying, does it make sense to maybe consider doing 2 years worth, like 30,000 in 1 year, or 3 years, 45,000 in 1 year, to kind of bunch years together? So I've got an example up here of Paul and Sally. They're 60 years old. This is just kind of giving you some information about them. They pay $5,000 a year in mortgage interest, $10,000 a year in state and income and property tax. And they, again, give that $15,000 to charity every year. So the reason I put these up here, if I add all those up, I've got $30,000 of total itemized deductions that Paul and Sally could claim. The standard deduction, what everybody gets that are married, age 60, is, I'm going to round it here and say about $26,000. So they are getting some benefit here. They're $4,000 above that standard deduction that anybody else would give or get. That $4,000, again, assuming they're paying 25% tax rate, they're saving, about $1,000 per year by doing this. So in other words, their $15,000 a year gift, they're getting about $1,000 tax savings on it, which is kind of surprising when you're going to give $15,000 to charity and I'm getting a $1,000 tax break. Obviously, the benefits of giving to charity are the most important, but we want to make sure you're getting the tax benefits you deserve too, right?
And this was something that I'm going to say Trump, when he made the tax changes that he did when he was in office, he moved up the standard deduction to where it was really high, to where it really hindered retirees that are charitably inclined. And so this is a strategy that helps. I mean, if you're in that category, we had CPAs we worked with that talked about retirees the first year after that they saw a substantial increase in the amount of taxes they were paying year over year, even though they were giving the same level. But just an interesting tidbit is, if you think about it, like if this isn't something you've inquired on or looked into, and you do give some level of income towards a charity, it's something, this is a great strategy. So I kind of highlight that. And it's a great strategy for the next few years until the tax code potentially changes. And that's why it's like, you got to keep your nose to the grindstone, so to speak, with paying attention to what's going on. But
yeah, great point. Because the rules could change on this at any time. So obviously these strategies change over time as well, but that's a good point. This is really useful for those that either aren't quite getting over that standard deduction hump or just barely over, like in the case of Paul and Sally here. To show that visually, now I'm using a 3-year example here. Again, keep in mind, you could do this with a 2-year window, a 5-year window, whatever makes sense for you and what is feasible for you. But in this example, I did an idea here of what if they gave 3 years worth of charitable in 1 year. So they got the same $5,000 of mortgage interest, the same $10,000 of state and local taxes, but now they're giving $45,000 in that year instead of the normal 15. So now their itemized deductions jumps up to 60,000. So I'm going to do a little bit of rounding here again. Again, assuming the standard deduction is 26,000, the additional 34,000 that they're able to take, assuming that 25% tax rate, allows them to save $8,500 in taxes over this 3-year window, as opposed to saving $3,000 if they were just getting the $1,000 per year in years 1, 2, and 3. So again, the idea of lumping those together allows you to get a bigger tax break and bigger, tax savings by lumping those together.
So Tyson, I want to bring that home, because that's the punchline, right? Like that's it. Like you said $8,500 is the tax savings over. Is that it over the 3,000, or is it so it's flat. 5,500 more?
You got it.
So in other words, this couple, if they are able to pay 3 years worth of charitable giving that they would do in 1 year, and then not do it for 2 years after, they're saving an extra $5,500. That's a lot of money for someone who's, in this income bracket. This is a lot of tax savings. But the difficulty is actually the cash flow of this, right?
Exactly.
So the difficulty is actually having the money to pay that much in charitable
for sure
in advance. Which is why we see a lot of people only do 2 years at a time, because I had a cousin who had an investment pay him back, and he did 7 years at once, and he knew he was going to pay tithing forever. And so he decided to pay 7 years in advance, which I thought was pretty interesting.
But to your previous example of donating appreciated securities, this is one way. If a client has, or an individual has, a large non-retirement account, just like a stock or brokerage account, a lot of times there's big gains in there, and they can bunch with those assets.
Absolutely.
Right? So
yeah, this is made even more powerful using those appreciated assets. And you're right, trying to do 3 years worth of giving isn't going to work for everybody. I mean, that's quite a bit of cash that's needed to do that. So that's where maybe the stocks and that non-retirement brokerage account help. But even then, it might not be.
So we base this on a 25% tax bracket.
Yep.
Is that right? So that's someone, for this couple, somebody said this must be based on a pretty high income bracket. So a couple would be paying 25% roughly in federal and state taxes together if they were making like $125,000 a year.
Mm-hmm.
So we're not, we're talking about
Combining the federal and state is
combining federal and state, but and maybe that feels like a lot, but we know that a lot of our clients are over that mark. And
well, in the math, even though the numbers are going to be higher, the math would still play out. So even if we bring this down, we bring the tax brackets down, the percentage of 3,000 versus 8,000, it's still going to be proportional. It'll change a little bit, but for the most part, the takeaway will stay the same.
Yeah,
because we're assuming that tax bracket of 25% stays consistent. So if you're 25% or 17%, it's still 100% more than where you're currently sitting in savings.
So someone asked the question, they would not save anything in the second or third year. And the reality is they would save on taxes in the second and third year because they get to use the standard deduction.
And that's the difference.
You would add to that, Tyson?
Yeah, I mean, I guess you're not saving the 1,000 that you would have saved in year 2, but that's because you saved 8,500 in year 1, which is making up for the fact you're not getting the additional deduction above the standard in years 2 and 3.
So basically, you're sacrificing 1,000 in year 2, and you're sacrificing 1,000 in year 3 to pick up an extra 5,500 in year 1.
Right.
Yeah, that's a good trade-off, right?
Yeah.
And with the bunching, you don't have to give in the first year. You could take the standard deduction for year 1 and year 2, save up your money or put it into an investment account, and then donate it in year 3, or even January of year 3, and then December of year 3.
Yeah, for sure. And to Matt's point, your tax rates may change. Year 1 may be the last year of your full employment where you're making a really high income when you need that deduction the most. And year 2 might be when your income falls for whatever reason, right? But that actually dovetails pretty well into the next one, which we'll look at in just a second. Quick summary again, concept of bunching. combine multiple years worth of giving into one strategy to help maximize the tax benefits of the charitable giving you're already doing. Most useful when you're not quite meeting the standard deduction or maybe only getting over it by a little bit. And again, very powerful when used to offset years where maybe you have higher than normal income, or maybe it's your last year of really high income right before retirement, for example. So that brings me to kind of taking that bunching concept and the gifting appreciated assets and helping with that concern around, do I really want to give 3 years worth, or can I give 3 years worth all at once to a charity? So we're going to talk about using donor advised fund. I've got the acronym DAF. You'll hear that term out there as you read and listen to podcasts and whatnot. But just wanted to give the example again. So we just talked about giving either cash or assets directly to a charity.
And you said cash or assets. That answers one of the questions here. Steve
Okay.
asked, does the bunching scenario only apply to those who have significant stock gains?
Absolutely not. I mean, it makes it better because you're avoiding the capital gains on those significant stock gains, but it still helps if you just have cash because we're still getting over that standard deduction hump.
Yeah, that was my cousin. So he had actual cash. He had like $80,000 in cash, and he did a little over $10,000 a year in tithing. And so he dropped $80,000 into charitable giving in that year.
Yeah. Yep, exactly.
He also lived in a car during college. So, I mean, take that for what it's worth.
Yeah, take
Been there,
that,
been
Zach's
there.
cousin.
Been there.
Side note, we had a client come in who worked with him, and I'm like, oh, so you worked with that guy. Like, he's a great guy, but it's like, don't judge me. I love my cousin though. Anyway, go on.
Yeah. So anyways, one of the problems with that, of course, is, I'm giving quite a bit to charity in that first year, which requires a lot of cash. And again, I'm just giving that much to charity all in the same year, which maybe I would rather, split that up over the 3 years. So that is one of the drawbacks with that bunching strategy, is both the deduction or the tax benefit and the gift occur in the same tax year. Concept of using a donor advised fund, which just think of that as another charity. It really is its own charitable entity that can accept gifts or donations from donors, and it holds those gifts from donors to then, give to other charities at the donor's discretion. So, for example, let's say that instead of giving the $45,000 straight to the charity, in this case, the Utah Diaper Bank for me, I'm going to give $45,000 to this donor advised fund with the intent they're just going to hold it for me for a while, but I really want that deduction, that tax deduction this year. So I want to make sure that I make that gift this year to get my tax break this year because I won the lottery or some crazy income event happened and I need to offset income. Or again, I'm not quite getting over that standard deduction hump or just barely getting over it, and I would be benefited by getting a little bit bigger deduction. The benefit of using the donor advised fund, there's a lot of them, but the primary one is it allows me to separate the timing of when I get a deduction and when I give the gift. So in this example, I don't know if it's going to go forward or not.
Hold on, that's my bad. Go ahead.
In this example, again, let's say I gave $45,000 to my donor advised fund this year, but I don't want to give all $45,000 to the diaper bank this year. I want to give $15,000 this year, $15,000 in year 2, and $15,000 in year 3. So what this allows me to do is to get a full deduction for that $45,000 and really use that bunching strategy we talked about earlier, but not give all of it to charity at once either. So I can still make, my normal gifts that I would make any other year going forward.
Tyson, can I make a comment? One thing I love about the DAF is that I think a lot of times clients haven't really decided where they want to give yet. Right. And so you use Diaper Bank 3 different years, but maybe this client is saying, hey, I know I want to get a deduction of $45,000, but I don't know yet where I want to donate that money to. And so really down the road, they can decide those charities. They don't have to identify those up front.
And most people invest the money inside the DAF too, right? And it grows without having to pay any taxes on that gain that happens, because the gain is inside a charity, which does not pay taxes on growth.
Yeah.
So that's for sure a benefit, right?
Zach stole my thunder on
I'm
that
really
one.
sorry,
That was going to be my
Tyson.
closing comment on using
Oh.
donor advised funds.
That's it for
but
charitable giving today.
Oh.
Yeah, we're done.
We're done.
No, but that is pretty awesome because that money can continue to grow, which again goes back to allowing you to give more and enhance your charitable giving.
Tyson, or stay on mic as much as you can there.
Okay. So again, a couple quick bullet points on donor advised funds, just to summarize those. Big takeaway here. They allow you to separate the timing of when you make your gift and when you get the tax deductions. Really useful for those who like to give consistently, maybe to different charities, but they like to give consistently year over year, but may benefit from controlling the timing of their deduction because they get, bigger income years here and there, or they sell an asset that has a big gain on it and they need that deduction more in that year. Really awesome for those that want to control when they get the deduction. Anything else you guys would add?
I have a client who's retiring, making a lot of money in the last 2 years of his retirement. They're selling a business, but the business is very profitable. They know they will give to charities for the rest of their lives. So the way that they do that is they front load the DAF with a bunch of their earnings. They are in a 39% tax bracket this year. So they can put it in the DAF this year. When they retire, they're very frugal. They'll probably only be in a 12 to 22% tax bracket federally. So why not avoid 39% today instead of avoiding 12 to 22 later? I mean, that's a huge tax savings on every dollar. And they don't, to Tyler's point, they don't have to decide the charity today. They can just put it in the DAF, let it grow. We see people use DAFs as an education tool for their kids to determine, help have their kids learn how to pick charities, research charities, have them get in a spirit of giving, all of those things. So a lot of tools, a lot of good uses for them. It makes it work.
For sure. So last strategy I'll touch on, this is qualified charitable distribution. So this goes back to one of the questions that came up earlier. I think maybe you brought it up, Zach, using your IRA for your charitable giving. So I'm going to use Paul and Sally again. They're a little bit older. They're 72, which means they've got this required minimum distribution on Sally's IRA. Sally's the one that has an IRA here, and she's got a $25,000 required minimum distribution. That money has to come out at some time that year, but they're still giving $15,000 to charity.
Sorry, I'm typing answers. Here we go.
You're good. So typically when Sally takes her required minimum coming out of that IRA, that $25,000 is treated as taxable income. And again, say it's, the 25% tax rate in this example. An idea for her is instead of taking that money to the bank and then, giving the $15,000 to the charity, something that she has the option to do is take that $25,000 or a portion of it and give it straight to a charity. So if she's giving $15,000 to charity, like we talked about, as long as that money goes directly from her IRA to the charity, it's as if that money never happened or that income never happened. She doesn't have to claim it as income. There's no itemized deduction for it as well, which is nice because you still get whatever other itemizations you have or the standard, whatever's higher. Basically, she gets to avoid $15,000 of income right off the top.
And this is interesting because we've been talking about strategies that have hindered people that are charitable giving. Well, old retirees that maybe just have Social Security and some income from their portfolio aren't going to give enough or have enough in the way of deductions to surpass the standard deduction. You get a bonus, you get a little extra kicker when you're above 65 years old in the household on both, to where this is a way that in this current tax code that allows you to be able to still take advantage of getting deductions or getting credit for it. I always bring this up and I keep saying because the tax code's evolving and changing. And so this is part of what we do here at Capita is we help to make sure that you're not having to worry about it. Now, if it's something you're hearing us talk about and you're like, I don't know if I should be doing that or if this is a good idea, it's probably a good conversation point to bring up to someone.
One thing I was going to add on that, Tyson, one of the conversations we often have with our clients and retirees is that their total income affects a lot of different things. And one of those things is Medicare. The Medicare premiums they pay is based on their modified adjusted gross income. And what I love about this is if you're nearing a threshold, whether it be a Medicare surplus, or maybe you're pre-65 and you need to be on Obamacare and you're trying to control your income, this never shows up as income. And so it really helps you reduce the amount of income that you show, thus keeping you under some of those limits that could trigger additional taxes.
Hey, Tyson, we're getting some questions around the age limits for this. Could you go over specifically, who can do a qualified charitable distribution? Maybe compare that with like minimum distributions and how that works a little bit.
Yep. In fact, I don't know if it's moved yet, but
okay.
on the last slide, couple bullet points, just in case you guys download these slides after. So kind of interesting rule here. So you do have to be 70 and a half, or once you're 70 and a half is when you can start to do these, which means you're not necessarily, you don't have to have that required minimum, because you can be 70 and a half and not have the required minimum distribution. And in a lot of cases, it still might make sense to do this even before you have that required minimum, because then we're doing that charitable giving and getting maybe some of those dollars out of that IRA in a tax efficient way for you. So that is one of the requirements. You have to be 70 and a half. Can only be used with an IRA is a key point as well. So if you've got 401ks, 403bs, can't do the QCDs from those. Does have to go directly to the charity as well. That's one where you want to make sure you do that right. You're not taking the money and putting it in your bank first. There is a limit to $100,000 per tax year per person. Don't really run into that very often, but does that answer that question, or was there something else that was asked that I can?
That's it. Yeah. We do have a client that hits 100,000 every year
Really?
of QCDs.
Good for
Yeah.
them.
Zach, don't talk about my situation. Would you? I'm just kidding.
You're 70 and a
I
half.
know. Well, that was the that's to see if you're paying attention.
It said, one said, I thought QCDs could be used with 401ks also. And we understand that that is not correct, that we run into issues and understand that the code only allows it from IRAs and does not allow it from, thanks, Laura, from 401ks. Now, the other thing on this, you mentioned DAFs, or have you gotten to that last point yet? Did you? Okay, just make sure. Sorry. Apparently I'm doing
No,
a
I
lot too
didn't.
much
I
over
didn't
here
touch on
trying to
that.
keep
No,
up.
but that's a
Okay.
question that comes up a lot. Can I move my QCD to the DAF like we talked about earlier? Unfortunately, no. It cannot go to a donor advised fund as of right now. Again, tax laws and laws in general can change, but as of today.
Great.
But I'll throw one other thing in here. So a question that comes up a lot is, okay, I'm 70 and a half. I can do a QCD, or I can give appreciated stock. Which should I be doing for my charitable giving? That comes up
A lot.
quite a bit, right?
Yeah.
And that's a good question. I think that sometimes it could be, I think a lot of times the QCD makes the most sense, but as with most things, there's never like a blanket, always best answer. It could be a combination of both, depending upon what the asset is and what the client's, goals and plans are. But most of the time, the QCD is pretty tough to beat.
Because we're getting income tax that we're able to deduct rather than capital gains is going to be the primary reason. But it's going to be, your income could play a huge part in that. We've had it where we've had clients that have been able to realize gains and do different things that aren't paying really any taxes. So it's all like 100% personal on that. But
All right.
that's great.
I'm going to do another question,
go.
and I think Laura will be next, right? So let's get her that. Okay, so let me get this poll going. Americans spend 6.1 billion hours doing taxes each year. The average person spends how much time completing their 1040? Again, don't answer in the chat or the Q&A. Here comes the poll. I'm going to get that up in front of you, and I'll download the answers, and we'll figure out.
How many people are in America that pay taxes? Isn't the
Oh, I don't
population like
know.
around 300,
That's a
400
loaded
million?
question.
That is a loaded question, because a large swath of people they report and do a tax return, but don't pay taxes.
Hey,
I didn't.
are
did I
we
say
trying to
something
slander
bad?
the wealthy? Zach, sorry about that.
Hey, the
If you're-
answers are 2 hours, 5 hours, 8 hours, and 13 hours. And let's see, we have about 61% of you have responded, and responses are still coming through. But
I'm really interested to see what they think the average is, because that might be telling to what they might spend.
yeah,
perhaps.
2 hours, 5 hours, 8 hours, and 13 hours. Here we go. I'm ending the poll so I'm going to share the results, and then I'm going to take a little bit of time after that, figuring out who won.
Answer's always D. We learned last time, right?
I think it was C. I think you actually said C.
D. It's D on this one.
C.
Oh, look at that.
C.
It is D. It's 13 hours. 13
That's why.
hours. Can you believe that? The average person spends 13 hours completing their 1040. So
That puts in perspective how much you pay a CPA potentially for some basic returns.
it's true.
If an individual would have spent that long doing it.
That's
Anyways,
surprising that they
we're not-
spend that long.
I thought the same thing. I was really surprised, because most people just send all their documents over to the CPA. I think that this might have, sometimes I hate surveys. There might be some selection bias here. Like the only people answering are the ones that are really upset about it. I don't know.
Maybe it accounts for the time that they spent stressing.
It's a bad
about
survey.
their
Yeah.
taxes.
We don't believe in surveys here. This one's not. I don't know.
This is
All
them triple and quadruple checking their return, right?
All right. So let's see if I can get the right poll up, figure out who got it. Well,
I feel like I would have guessed 5. I would have felt like 2 was too short.
Let's do this. I'm gonna let you guys keep going so that you don't wait on me. Let's get Laura talking.
Laura's
and
gone.
before the next question, I'll tell you who won this one.
Hey, and I was just going to say, because I think we forgot to mention this at the beginning, at the bottom right of this screen, you guys will notice a QR code. You may be like frantically taking notes on all of this, and we just want you to know you have access to all of these slides. If you take a picture of that with your phone, that QR code there, it'll take you to a landing page where you can just download all of these slides. And of course, we'll send out this recording at the end as well.
It's one of those where we'd normally tell you how to use a QR code, but now it's like, because of COVID, you just go to Texas Roadhouse and they'll show you how to use one.
Yeah, you can't eat at a restaurant.
You're not going to
without knowing how to do it right.
Get it.
Awesome. Okay, well, we're going to jump into the Roth. I feel like the Roth is something that everybody has heard of, but they don't know exactly how it works. So we're going to jump through talking about the benefits, some common misconceptions, and how you can use it to take advantage of it. So something that's really important to understand about the Roth, a lot of people think that the Roth is the type of account that they have. They say, yes, that's my Roth account. But really, the account type is the type of account that it is. You have your 401ks, your 403bs, 457s, HSAs, IRAs. That's the account type. And then inside of the account type, you have the tax type, meaning you can have a traditional and a Roth 401k. You can have a traditional and a Roth 403b, traditional or Roth IRA, etc. So that's the tax type, not the account type. And then inside of the account, you have the investment types. So there's stocks, bonds, cash, real estate, etc. We're not going to talk as much about the investment side of things today, but hopefully that gives you an overall idea that the Roth is the tax type, not the account type. Okay, so let's talk through the different tax categories for the different accounts. So your traditional means that you are not paying taxes on any of the dollars that are going into a traditional account. You're deferring those taxes until later. That account grows, and then in retirement, when you take the funds out, everything is taxable to you, the amount that you put in and the growth inside of the account, and that's taxed at ordinary income rates. With an after-tax account, you can see this blue one here. This is like a bank account, a brokerage account. You're putting in dollars that you've already paid taxes on. And then when that account grows, you only have to pay taxes on the growth that you have inside of the account, not the amount that you initially put in. So you put in $10, it grows to $15. You're paying on that $5, and it's taxed at capital gains rates. We'll talk a little bit about that later. With a Roth account, everything that's going into the account, you've already paid taxes on. And then that account grows throughout, through your working years, and in retirement, when you start to draw from it, it's completely tax-free. The money that you put in and the growth inside of the account. The HSA is the last one. You can see it's all green. This is the most tax efficient account out there. Everything that you put in is tax-free. Everything that you take out for medical costs is also tax-free. So really, it's the best way to save on taxes. So that's why we always encourage people to max out their HSAs. Something to keep in mind, you can see the 401k and the HSA matches. That's from your employer. Those will always be traditional. So those will always be before taxes. So even if you're doing Roth contributions, your employer match will be traditional.
Just to connect the dots here, Laura, from that blue bucket there, the after tax, to Tyson's presentation, he talked about donating appreciated assets.
Yep.
That's where that's coming from.
That's
Is that
the
blue?
one.
Yeah.
Thanks for pointing that out, Tyler.
All right, Robert Hilliard won, by the way. You won, Robert.
Congrats,
Congrats.
Robert.
You, Robert.
Nice, Robert.
All right, back to the presentation.
Okay, so this takes us to the question, to Roth or not to Roth? Should I be doing traditional contributions or should I be doing Roth contributions? A lot of people have the misconception that they should be doing Roth. It's a magical account, grows tax-free. And they think in their minds, I should pay taxes when the balance is lower before it's had years of growth, because later down the road, it's going to be a bigger balance. I'm going to be paying more taxes, which I can see where they're coming from. That makes sense. But if we run the numbers on it, run the math here, we're going to run through two different routes. So the top route is the traditional route. So you have $10,000 from your employer. You decide to put it into your 401k through the traditional 401k. So the whole $10,000 goes into that traditional 401k. You don't pay taxes on any of those dollars. you have it in some really good investments, it doubles over time. In retirement, when you take it out, remember all of that is taxable to you at ordinary income rates. Just for the sake of easy math, we are saying that it's taxed at a 25% tax rate. So you pay 25% on the 20,000, you're left with $15,000 of spendable assets. Okay. So let's start over and go the Roth route. So you have $10,000, you decide to pay taxes first. We're assuming the same tax rate, 25%, and you have a net amount that goes into the Roth of $7,500. You pay your taxes first. You're in the same investments as a traditional account. That money doubles over time. So you now have $15,000. Well, in retirement, you don't have to pay taxes on any of your Roth distributions. So you then have $15,000 of spendable dollars. So if everything's the same, if your tax rates are the same, it does not matter if you do traditional or Roth contributions. I think this kind of blows people's minds. And you have to run the numbers. We didn't make the numbers perfect to make sure it lined up. If you start with any amount of number and you have the same tax rate, it'll always turn out the same, which is kind of interesting. So if it doesn't matter, Roth versus traditional, why are we even talking about it? Well, if you're going to have a different tax rate before when you're contributing than you will in retirement, that's where it makes the big difference. And that will affect whether you do Roth contributions or not. It's almost deciding when you're going to be paying the lower tax rate. So we have some questions. Full disclosure, these are not $50 gift card questions.
Budget ran out of budget.
Unbelievable. I'm not participating.
Robert took the last one.
Robert and Pauline and I
Actually,
are
there's
done.
one more.
There is one more, so
There
stay.
is one more
Okay, never
50,
mind.
but it's not the next four questions.
It's not the next four, but this is to test yourself to see either how well you're listening or how well we're explaining it. So we're going to start here.
Ooh, oh, okay.
That was close.
Yes,
That was close.
Laura and I are both trying not to click too many times. All right, I'm going to launch it when you say
Okay,
go.
so we have a scenario. Your tax rate is going to drop in the future. So should you be doing traditional or Roth contributions now? So you can answer.
Pause. This
I
is
just launched it.
before you
It's gone. It's gone.
Okay, so
But they can still. They won't know the answer.
They
Go
won't know
ahead.
the answer.
Yeah.
go ahead. You first, Matt. I mean, you're on camera, so you go 1st
I'm on.
that's true.
Well, now I'm like flustered. I feel like this is the most common scenario for retirees.
True.
Most people will live in retirement on about 80% of whatever their pre-retirement income is. And sometimes we see it a great deal less than their pre-retirement income because like the person you spoke about that's funding a DAF heavy and they're going to be in the 12%, 24%. That individual is going to have a lot lower income than what they're probably entitled to right now. This is super common. I'd say this is the majority of us like that work in the workforce.
yeah, most of the retirees we work with, I feel like a lot of them are up in that 22% federal tax bracket, right? So the idea is if they're going to drop into the 12 later, which one should they be doing? And that's kind of the question that we're asking here. Let's assume you're in the 22 now and you're going to drop into the 12. What should you do?
Okay, 67% said traditional, 24% said Roth, and it just changed. 12% said both, which,
Okay.
I mean, I can see 2 out of these 3 answers. Okay, so I'm going to share the results here so everybody can see this, and then I'll put it up on the screen for the presenters.
Okay.
Laura, what should you do?
Traditional. So if your tax rate is going to be lower later, let's wait and pay taxes then when it's later. So let's put it in traditional now. Let's defer taxes, pay it later.
All right. So I'm going to advance us so that you
Okay,
don't.
that's great.
Okay. Okay. So there you go, folks. There, I just shared the results with you. And we'll get back on traditional. There we go. Okay. So here is the next question.
So your tax rate is going to rise in the future. This might be somebody who's maybe new to the workforce. Maybe their income isn't quite as high yet. They're expecting to get some promotions, some raises.
Or somebody that's super pessimistic about the future solvency of the government.
Yeah.
Which
I just,
Which
I'm sorry.
happens.
Excuse me. But yeah, no, and I'll read this. See, I got a couple there. Got a few to.
Or this might be somebody who had lower income that year. They expect that they're going to get a new job the next year again, and income's going to go back up. So their tax rate is lower now. So most people got it right. You should do Roth. If your tax rate is lower now than it's going to be in the future, why don't you lock in that lower tax rate, pay the taxes now, get them over with, and then later down the road, you don't have to pay
we had
them.
92% say Roth and 7% say traditional, and 2% say both. By the way,
I like the guy that's saying both.
I-
He's sticking to it.
I'm,
That's part of
And you
being
know what? That
successful
would
in
be
investing
me.
is just being consistent.
that would be me too. I'll tell you.
Was
what.
it Woody Harrelson that said like 90% of success is just showing up? I
Yeah,
don't know. I
think
made
you're
that
right.
up.
That sounded
Somebody
good.
said
Sounded good, right?
Shouldn't have told us you made it up. Okay, next question.
Okay, this question, if you want to ultra max out your contribution limits, so we'll talk about the contribution limits later, but you can only put in a certain amount into your 401k. If you're wanting to ultra max that out, should you be putting it into the traditional or the Roth?
Okay, that's live now. So we're seeing a lot of people going with both. It's about 50% for both, 25-ish for traditional. I'll share this with you. I have to end the poll to share it with everybody. So I'll do that here in a second. Okay, I'm ending it and we'll share it with you. But there was about half of you said both. About 26% said traditional, 19% said Roth.
Okay, we kind of tricked people on this one. It's actually the Roth. So if you think about it, doing traditional contributions, some of that money is not yours. Some of it is going to have to be paid in taxes. So you're leaving room in that limit for someone else's money. It's like your parents who, all the kids are gone, but they still have all their junk at their house. At least that's my mom. She's trying to clean out everything from her house. And
Where are we going
get
with
rid
this,
of it.
Laura?
Is Pam watching tonight?
I hope so.
Probably is.
I know your struggle.
But keep my stuff, please. Right?
Yeah, don't throw it away, please. So with the Roth, everything that goes in is your money. You're not going to be paying any of that away in taxes. So if you're trying to max it out with all of your dollars, you want to do Roth. Now that doesn't necessarily mean that if you want to max out your 401k that you should be doing Roth. There are other ways to fund retirement. So you could do traditional, max it out, and then fund an IRA or an after-tax account as well.
Okay, couple thoughts here. Maybe so one client asked here, can you do a Roth and a company sponsored 401k? The answer is
Yes.
yes. And
Asterisk.
Thank you, Matt.
Yeah.
Where is the asterisk?
Income related, right?
So yeah, we'll talk about that later, you guys.
Oh, Steve
geez.
jumped the
Oh,
gun.
Steve, Zach.
Okay, so then the other thing about that max funding, this is a weird concept. And for me, it's just helpful to know, let's say you're over 50 and you can put $26,000 to a 401k. If I put 26,000 of Roth money, that's more money than 26,000 of traditional, right? Because some of that traditional money is part of the government's. So that for me, that's all this ultra max funding is. It's just, if I put the same dollar amount in, if I put Roth in, it's a little bit more.
Yeah,
right?
people that have bigger Roth accounts than traditional, they actually have more money to use in retirement.
Right.
Because some of it's all theirs. All their Roth is theirs.
Okay. Let me get the
Okay.
next poll up. This is the last one of the four.
Okay, perfect. So this one is, you want to keep your options open for tax management in retirement. Which contribution should you do?
Looking for my guy. Who's my number one from 2? Or lady.
I like it. I don't think they can see this yet. It's up on the screen, but
All of us just go dead silent.
did- yeah,
And
we're
we're
just
watching
watching.
results. Like I feel like it's like election night. We're like, oh
It's a
boy,
horse race.
Ohio's just reporting.
I was thinking like Olympic gymnastics when they're just watching 10, 9.9.
Yeah.
Okay, we're done. We're gonna end that one. Share these results.
Okay.
It is 54% for both, 32% for traditional, and 14% for Roth. Lara.
Awesome. Yep. The answer is both. The way that you can have control of your taxes in retirement is having a little bit of both. And we'll talk about this more. So yeah, great job. Great job, you guys. Great job on the questions and answers. Hopefully that's helpful.
Thank you.
Thanks, Matt.
For me.
Okay, we're going to talk a little bit about the tax rates. We're by no means tax experts, but I just wanted to explain about the basics of tax and how it works. I'm going to be talking with the married filing jointly numbers, but the single numbers are on the left. So just so you know, everyone pays 10% on the first $20,000 that they earn. No matter how much money you make, everyone's paying 10% on the first $20,000. Any dollars above that, up to $81,000, you're then paying 12% on those dollars. Anything above that, up to $172,000, you're paying 22% on, etc. Some people hear that they're in the 24% tax bracket and they assume that they're now paying 24% on all of their dollars, which is not the case. The reason I'm putting this up here is to help give you an idea of if your tax rate is high or low. So the lowest tax rates are 10 and 12%. So if you're in the 10 and 12%, it probably makes sense to do Roth contributions. Now, with that being said, if you're really close to retirement, you know that you're likely not going to owe any taxes in retirement, then no, do traditional. But for the majority of people, their income's probably going to go up, or they're a long time out from retirement. So it's a good idea just to lock in that 10 and 12% tax rate, pay Roth now.
So Laura, you're talking about contributions, but I think the same thing could be said for conversions.
Absolutely.
Right?
Yeah.
Somebody in a 10 and 12% tax bracket should heavily consider conversions. I'm not going to steal your thunder because I know that there's a slide later, but but most of our clients are in that phase of life. So maybe use those words synonymously in your mind.
Yeah.
And I'm thinking historically, we're seeing some of the lowest tax rates we've ever seen.
Right.
And
Right
so
now,
to take
yeah.
advantage of this from a conversion or a contribution standpoint,
Yeah.
like this is money.
Yeah, absolutely. In 2026, the Trump tax laws are set to go back. And so the 12% tax bracket will then be the 15, 22, 25, 24 to 28, et cetera. So yeah, you can lock in a 12% rate now. Great.
One last thing on this too, Laura. So I've got a lot of clients I work with. Their income changes a lot year to year for various reasons. They get a lot of their compensation from stock awards or other things. So, whatever the strategy is for this year might be different than the next year if they're
Yeah.
going to change drastically in these tax brackets. And that's just something to think of because a lot of people set their 401k contributions and then let it go. And they may not be revisiting that if their income changes, or if you set it 10 years ago, your income could be a lot different than it was back then.
Yeah,
So
that's a
thing to
good point,
revisit.
Tyson. Good thing to revisit. Okay, I'm going to skip down to the bottom, the traditional. So if you're in the, 35, 37% tax bracket, you're earning over 420,000 or 330,000, you're probably not going to be spending that much in retirement. Like Matt said, most people aren't spending as much in retirement as what they're earning in their highest earning years. So for those people, it makes sense. Do traditional contributions now. Let's defer those taxes until retirement when your income's probably going to be lower and therefore your tax rate. This blue bar in the middle, the people in the 22 and 24% tax bracket, these are for people earning between 81,000 and 330,000, which is a good chunk of people. It's kind of a depends answer, which can be kind of hard. But if you think about your situation, if you're really young and you're paying 22, 24%, you expect your earnings to go up. Maybe it's a good idea to do Roth. If you're in your later years, you're about to go into retirement, your tax rate's going to drop. Probably a good idea to do traditional. If you're somewhere in between, a little bit of both is not a bad idea. So you can do some traditional 401k contributions. You can do some Roth 401k contributions.
You said it earlier that a Roth contribution will be matched with traditional dollars. So
Got it.
people who do Roth are actually getting some of
Yeah.
both anyway.
And adding to that too, one of the things that Trump did is he widened the income bracket, so to speak. So the threshold or the amount of income you get to count in 22% or 24 got wider. And so when you start to think about where you could be, you could just barely be in the 24%, or you could be way close to the top part. It's likely these are going to tighten again. If you're in the 24, you're probably going to be in the 28. And so it might even be something that's worthwhile, like looking back at the prior tax brackets, because it'll probably revert back to that.
Yeah, that's a good point. So hopefully this is helpful. You can see where you're at income wise if you don't know your tax rate and determine what type of contributions you should do. Okay, so we want to talk about tax management in retirement. Just a review of how your income is taxed in retirement. Any withdrawals that you take from your 401k and IRA, 403b, that's all fully taxed to you at ordinary income rates. Any pension income that you have is taxable to you. Your Social Security is taxed depending on the first two buckets. So if your income is low, not all of, or maybe none of your Social Security is taxed. If your income is high, then more of your Social Security will be taxed up to 85%. It's not an 85% tax rate. That just means that your 85% of your Social Security is put into your taxable income.
That's so important, you guys. I feel like when I share that with people, they go, I knew they were going to screw us. I knew they were going to get us. That's how it's done.
Yeah.
So it's every $1,000. The most you'll have to count towards your income is $850.
Yeah.
And then that's
and then it
taxed
goes
at
into
a
that tax
10
bracket.
or a 12 or a 22%.
Exactly.
I would say
tax bracket.
15% is always tax free, no matter
Yep.
how much money you earn.
Yep.
Perfect. And then this after-tax account, that's the growth. You pay capital gains rates on it. They're preferable to ordinary income rates. And then your Roth and HSA distributions that are used for medical purposes, those are tax-free. So showing how this worked, if you have different buckets of money to draw from, this is how you can help control your taxes in retirement. So your first bucket, the ordinary income, that's going to be your pension, your 401k withdrawals, Social Security is going to be in there. What you can do is you can control those withdrawals inside of there until you're getting close to maxing out, for example, the 12% tax bracket or $83,000. Once you're getting close to there, you can turn off those traditional withdrawals and start to take money from an after-tax account. So if you took out money from there, those long-term capital gains would be taxed at 15%. And then anything above there, you could take out of the HSA or the Roth, and you're paying 0% tax on it. Overall, you could be earning between $150,000 and $250,000 and be paying an overall tax rate of 10 to 11%. If that was all an ordinary income, if that was all coming from a traditional 401k, that would be taxed at 22, 24%. So this shows how you can manage that. If you're getting close to going over into the next tax bracket in retirement, you can start to use after-tax dollars or Roth dollars to help control those taxes.
I can't tell you how many times I've had a client tell me that they were going to retire and they have $200,000 or $300,000 in the bank, and they're just going to spend that for the first 2 or 3 or 4 years into retirement. And then later they'll start withdrawing from their 401k. It's like they had that money earmarked in their mind. And I understand what's happening there in their mind. That was their bridge, and they feel safe because they have their bridge. But the problem with that, if you look at this screen, is that they're missing out on the opportunity to get some of their IRA out at 10 and 12% tax brackets. And that's a shame because they'll never get that chance again for about $80,000 to $100,000 of their income to sneak it out at that bracket. So either they should be spending $80,000. This is a couple. Pretty much most of the numbers we've talked about have been for couples. So you cut them in half for single individuals. Just keep that in mind. But if they forego that opportunity, at least they should be doing a Roth conversion of $80,000 or $100,000 over to a Roth to fill up that 10 and 12, even if they truly want to spend that cash at the bank. So they can't just spend the cash and leave the account alone unless they want to miss out on it. That would cost them thousands of dollars over the course of the couple of years by that missed opportunity of the 10 and 12% brackets.
And I can't express how important this is. Now, we're not CPAs, of course, but we know enough about taxes to be dangerous and really help clients strategize this. And then a lot of times we'll consult with the CPA to confirm, hey, we're thinking about doing this. Do you give us our approval? And then we'll do it. One quick story. I'm working with a retiree right now, and she's 62. She's got 3 years to bridge before Medicare. So she's got to jump on Affordable Care Act, but we're watching those limits because you get a subsidy on Affordable Care Act if you're under a certain income limit. And so she, talking about the different buckets of money here, she has a Roth money, luckily. And so we're going to be able to take out up to that limit in like IRAs and 401ks and pension and Social Security. And then we'll take out Roth, anything above that line, to make sure she gets a full subsidy from the government. And it's just little strategies like that I think a lot of retirees will miss if they do it on their own.
100%. And I think if you have like a CPA that you're working with, you're like, they're doing this for me. But oftentimes the CPAs, they're not incentivized. Like they don't get paid based off the amount of tax savings they get or generate for you. So this is a lot of the reason why we have a niche of being able to help bridge that gap, which is really a fun part that we get to play in there.
Something to throw out. We actually analyze people's tax returns, and many of you clients know this. So if you want to give us your tax return, we'll throw it in our software, analyze it, and we can model out exactly what Tyler's talking about, what Matt's talking about. So Tyler said we know enough to be dangerous. I think we know enough to be right. And then we usually end up telling the CPA what a really great idea. And then they're like, oh, that is a great idea. And maybe that's arrogant of me, but I don't know. It's our specialty. We'll own it.
You can tell how awesome of a topic of this is because we all have things we want to throw in. And my piece is like, I think of this like I think of diversification with your stocks and bonds. Like how important is it to have diversified buckets of money that you could utilize in retirement? I think so many times we come across clients who are caught in the trap of the next dollar I save always has to go into the 401k or the IRA. And a lot of times that might be true, but maybe not always. Maybe it's worth slowing down a little bit and thinking through some of this to think, is there a better way or better place we could put that next savings dollar? So
Love it. That's great. Okay, I did want to touch on contribution and income limits that you have for each of the different accounts. So for a Roth or traditional 401k right now for 2022, the annual contribution limit is $20,500, and that's for either or. So you could do half to the Roth, half to the traditional, but 20,000 between
And
the
this
two.
is if your employer matches on top of that.
It doesn't include that.
Yeah.
Great point, Matt. Yep, doesn't include any employer match. So that can be all of your dollars. If you are over the age of 50, they give you a little bit of a catch up. So you could contribute 27,000. The annual income limit. So some of these accounts have limits on how much you can earn in order to do these. For the 401k, there are no annual income limits. Doesn't matter how much income you have, you can still continue to do Roth 401k or traditional 401k contributions, which is a common misconception. With traditional and Roth IRAs, you can put up to $6,000 of earned income into those accounts. If you earn $5,000, you can put in $5,000. If you don't have any earned income, you cannot contribute to these IRAs. And the same, it goes for the two. So 6,000 between the two of them. You could do 3,000 to the traditional, 3,000 to the Roth, but 6,000 together, or 7,000 for people over the age of 50. Something to be aware of. There are annual income limits on the traditional and the Roth IRAs. So if you are putting money into a traditional IRA, that's reducing your taxes or your income by that amount. You can get a tax deduction for it because we're deferring taxes till retirement. Well, if you are, if your income is above 109,000 and you have a 401k, they start to phase out that deduction. So you can't deduct money that you put into the traditional IRA.
And this was where we were getting ahead, Zach and I, for the question that was asked earlier about, can you contribute to both? Well, that's kind of your answer, right? If you're above those thresholds, they move it up on the Roth because the government's getting paid their taxes and most politicians only care about the next 4 years. So when this law got entered, they're like, well, who cares in 4 years? By the time these guys are starting to take money out of Roths, we'll be dead. And so because of that, they didn't care.
Yeah. And with the Roth IRA, you're not getting a tax deduction, but you actually cannot contribute to a Roth IRA starting at $204,000 for a married filing jointly couple.
and I know we're trying to move quick through these, but also non-working spouses, if there's a non-working spouse, can qualify off the working spouse's income to
That's a good point.
the spouse IRA too.
Yep.
So
other thing- oh,
hold on, Tyson, to clarify, you're talking about, so the Roth IRA is not working, not working. So this middle row here, this middle row with the orange traditional IRA bar, it gets complicated. Can we just throw that out there? It
Yeah.
gets complicated, and we probably won't go in the details with it, but it has to do with whether or not you're eligible to participate in a 401k plan or a pension plan or employer sponsored plan, or if your spouse is eligible, then all those limits change. The Roth IRA is just straight up, do you make this much or more? You can't do it. That's it.
I was more saying, like, let's say it's 50,000 of income for the whole house, and none of those limits matter. Both spouses can contribute, even if one of the spouses wasn't
Oh, I
earning the
see.
50,000.
Very
Yeah.
good point.
And you
Okay.
could max out the 401k and then also max out the IRA for each one. That's a great point.
Sometimes we see individuals who are over that 204 threshold. There is a strategy called a backdoor Roth, which we won't go into tonight. But if you're over that limit, just know there is an option to be able to get money into a Roth. Call your advisor. We'd be happy to help you understand that.
Hey, we got a question on the last section that I just want. And by the way, this Roth topic is a big one. And Tyler has Social Security updates, but Tyler presents on Social Security every week. So you get to decide. You're the accordion of this presentation. You have to adapt anyway.
Yeah.
So deal with it, I guess. Laura, the question is, how does the death of a spouse, and I'd be interested in everyone's opinion, after retirement, how does the death of a spouse after retirement affect the choice of Roth or IRA traditional?
That's
And
interesting.
tax rate will go up,
Yeah, because you're
spouse
now filing single. And so it's going to be lower. So if it's going to make that big of a difference, then you could take more dollars out of your traditional account, get it in at a lower tax rate. If when your spouse dies, you're going to be into a higher tax rate. You'd have to run the numbers to see if
Yeah.
that makes sense. But
No,
that's
I
something
think
to
it
think about.
leads to the concept of contributing and converting more to a Roth, so that when you're in that higher tax bracket after a spouse passes away, you can get money out of your Roth at a tax-free rate. Now, you have to really be, you need to know your family's health situation, right?
Yeah.
If a lot of spouses don't pass away that different from each other. I mean, I say that different, more than 5 to 10 years from each other, but it happens all the time where someone passes away and somebody else lives for 20 or 30 years. We all know people that are in that situation. But if you do know you have a family health situation between the couples, that one is very likely to pass away early and the other was going to live for a long time, I think I would strongly consider going up into the 22 and maybe the 24% tax bracket to convert.
Yeah, if they're going to be in the 32% tax bracket later, especially.
Right.
Yeah, that's a good point. Great question. Okay, Roth conversion. So what if you have already done all of your contributions to the traditional account and you want to get them into Roth? This can be a great option if you are in a lower tax year. We kind of talked about this before, but say someone retires and they haven't flipped on Social Security yet, and they have some room in their 10 and 12% tax bucket, and they could fill that up by converting money from the traditional account to the Roth. There are no limits of how much you can convert, no annual income limits either. But just know any money that you move from the traditional to the Roth account is taxed at ordinary income rates. That then, becomes taxable income to you. We're going to talk a little bit more about that. But another advantage of doing a Roth conversion is to reduce the RMD amounts that you have in the future. We talked about this before. At age 72, the government makes you take a portion of your traditional accounts out to pay taxes on it. It's called your required minimum distribution. It starts, like I said, at age 72. So you don't have those from a Roth account. So if you have a large traditional account, you're going to have to take out large RMDs. You can do some Roth conversions. So you reduces that RMD
What if I
amount.
make a big bunching gift to the diaper bank? Would that be a good year to do a Roth conversion too?
Yeah. Yeah, that's true.
Thanks for the tip.
You're welcome. You got it.
Okay, so I'm going to answer a couple questions really quick. We need to keep moving, but I'm going to tackle them. They're in the Q&A. What can you do if your employer limits 5% of the amount you can contribute to the 401k? So you may have a plan that has employee testing limits where if the other employees are not contributing enough, you will be also limited to how much you can contribute. And the answer is there are plenty of other ways to save. In fact, there's a growing body of evidence out there that it makes sense to save a lot outside of retirement plans because of the preferential treatments of capital gains tax. So the bottom line is decide how much you want to save first, put a bunch into the 401k, and then there are a whole bunch of other options. Talk to us. We'll go through that with you. Another question, when you're using the annual income numbers, are those total or adjusted gross income? Depends. This is hard, Pam, because we've given limits that have to do with AGI, limits that have to do with total income, and limits that have to do with net income. And we haven't specified because our presentation would come in at about 2.5 hours if all three have been represented today. This is why we need to work together and look at your situation specifically. But yeah, that's a great question, and you do have to be really careful about it. And then the last question, can you add to a Roth if you are retired? Laura's going over it right now. One way to add to a Roth is through a conversion. If you do not have earned income, you cannot make a contribution to a Roth. That's the bottom line. Or a traditional. You have to have earned income, or your spouse has to have earned income. Earned income could be even like contractor work. It doesn't have to be a typical W-2 or self-employed work. That could work too. But bottom line is you have to have earned income. If you don't, you have to do a conversion to get it over.
Right. Pensions don't count for that. It's earned income, like you said. Okay, this is the last point we're going to talk about. Something to be aware of if you are thinking about doing Roth conversions and you're on Social Security. So when you are converting dollars to Roth, that then fills up your 10 and 12% tax bracket, and which then increases the amount of your Social Security that then becomes taxable. We're going to go through an example here. So say someone has an adjusted gross income of $20,000 and a Social Security benefits, these are annual amounts of $40,000. Since their adjusted gross income is low enough, only 10% of their Social Security is taxable, or $4,000. So say somebody wants to do a $30,000 Roth conversion, take advantage of that 12% tax bracket. Well, when they do that, it increases their AGI to $50,000. Well, now that their AGI has jumped up to $50,000, 70% of their Social Security then becomes taxable. So instead of putting $4,000 from Social Security into the taxable amount, now $28,000 is put into the taxable amount. So when you add $30,000 of a Roth conversion, it actually increases your income by $54,000, your taxable income by $54,000, which results in a tax bill of over $5,000. So if we run the numbers, what's $5,000 of the $30,000 that we converted? It's actually a 19.5% tax rate.
But
So,
Laura, they're in the 12% tax bracket.
yeah, but because you're paying,
I mean, that's the question I get from clients.
Yeah.
That's
And it
I'm
makes
doing
sense.
that facetiously, right? Like that's what they tell me. But I'm in the 12% tax bracket.
yeah, but you are paying 12% on more dollars. You're paying 12% on that $24,000 of Social Security that you weren't before.
This is one of my favorite stories of this is they will remain unnamed, but we know of an advisor that we've had conversations with that I believe, Zach, you're the one that had this, where we literally you explained this to him and he's like, I don't know if that's how it works. To where my point in saying it is we're describing a complex, but also like a common problem that people are going to run into if they do Roth conversions. And if there's a lot of advisors that aren't aware of it,
Not savvy to it.
not savvy to it, because
Yeah.
this is in the weeds.
Yeah.
So, and then there was a question here, and this slide answers the question. It says, did I understand that you cannot convert from traditional to Roth if you are on Social Security? And
That's a great question. So no, you absolutely can. You just want to be aware of the consequences of your Social Security. If you're already maxing out, you're already paying taxes on 85% of your Social Security anyways.
Yep.
That's fine. It's not going to affect it. And you're just paying taxes on the extra Roth conversion. So you can, it's just something to be aware of. If you have questions about it and want to know how it will affect your Social Security, just give us a call.
okay. Question time, and Tyler will go next. We had that whole section on Roths, right? Roth IRA balances grew by what percent from 2014 to 2019?
I haven't looked at the answer and I want to try to guess.
I think you should. I'm going to get the poll going.
What do we got?
Hold on.
Give it to us.
It's always
Um,
D.
Okay, so we know.
So Roth IRA balances grew by
Oh.
what percent from 2014 to 19? You should be able to answer. This is a $50 gift card one, by the
But
way.
part of me feels like this is a harder question because you've got contributions that play into this, plus the market did pretty darn good.
Right.
So if you think,
Conversions, contributions,
So if you
market
think-
growth.
if you think the market on its own was 15% a year, let's say, that's 45% growth. So that gets us out of, I'm like trying to answer it.
All right.
I'd say
have-
70 to 112.
Okay, so the
is
answers
in
are
my-
37%, 52%, 70%, and 112%. We have a bunch of people who have participated. I'm ending it now and we'll share the results. 30% of you said 70%, 22% said 112, and the answer was 70%. So 30% of you got it right. Here's the breakdown. Of that 70%, 51%, or so half of that growth came from markets.
Wow.
Yes, I did a good guess, 45%.
Yes.
Just wanted to put that out.
Okay.
You're not eligible for the gift card, Matt. I'm
I know,
sorry.
but that's a cool fact that I just threw out.
And then 23% from rollovers and conversions, 26% from contributions. Let's move on, and I'll work on. Just know if your slides aren't working, it's because I'm trying to figure out who won.
I don't need slides.
Okay, but Tyler, let's get you going.
I just want to say buckle up. It's Social Security
It's just
time.
here it goes.
Buckle up.
Are you guys gonna let the Social Security nerd talk now?
Everybody
tried
splash
not
some,
to.
yeah,
Do I finally get a turn? All right.
splash some water on your face because here we go.
Get ready. Yeah, seriously. I got 14 minutes to get through this. This is an hour-long presentation. Okay, I'm just gonna hit the bullet points here because this is a 45-minute presentation that I do at a lot of employer groups. And I'm going to try to get through in 15 minutes, but I want to start with a story. I feel like we can illustrate Social Security the best when we talk about stories. And by the way, if you're a retiree on this call and you have not figured out a Social Security strategy yet, if you're not working with an advisor here at Capita or outside of Capita that understands Social Security, you've got to get this figured out. It plays a pivotal role in your success in retirement, right? And you could be leaving dollars on the table if you don't do this the right way at the right time. Okay, so I did a presentation for a school district down in Utah County, and about 2 weeks later, I had this individual come in. She was a single lady. She was married in the past, but when I met with her, she was divorced, 68, planning to retire within the next year. Now, because her specific situation, because she was married in the past and that marriage lasted at least a decade, she didn't realize that she had been entitled to a divorced spousal benefit for the past 2 years. At 66, she could have walked into the Social Security Administration and said, I want that divorced spousal Social Security benefit, give it to me. They would have given it to her, but she just didn't know. And so for 2 years, she had been missing out on this. We realized that right away on the first appointment, and we had an application filed. We were able to backdate it 6 months. She had been missing out on $1,500 a month for 2 years. And unfortunately, here, the moral of the story is the Social Security Administration is not sitting around board saying, hey, who can we call today and inform them they're missing out on money, right? That doesn't happen. You are never going to get that call from the Social Security office. You, as a retiree, have to understand what you're entitled to and then go get it. And unfortunately, she missed out on some money. Like I said, we were able to backdate that and get her some of it, 6 months of it back. And now she's getting $1,500 a month. For her, she's going to delay her personal benefit till 70, switch over and maximize her benefit. So if you're on this call and you're single, if you're, single, never been married, or if you're single, married in the past, currently divorced, if you're looking to get married, if you're a widow or widower, there are specific strategies and things that you need to understand about Social Security that are critical to your success. Okay, so we're going to talk about the benefits of Social Security. It offers a lifetime income stream. So this is an income stream you cannot outlive. Of course, Capita here, we're financial advisors. And when we build an income plan, we love those streams of income that last forever, that don't go away, right? Guaranteed streams of income. And Social Security is one of those. So when we build a cash flow plan for a retiree, we always start, the foundational piece of that plan is always Social Security. Let's get that decision right first, but then how you file for your pension, how you take your 401k, how you're distributing from your IRA, those all go together. You got to piece them all together, but we need to start with Social Security first. The second one, income adjustments. Social Security does offer a cost of living adjustment. By the way, if you're on Social Security, you probably know this, but they just instituted or gave us the highest cost of living adjustment that we received in the last 39 years. In 2021, which was given to you in the year 2022, 5.9%. We haven't seen it that high since 1982. So this is amazing. You all received that, whether you're on Social Security or not, but a massive increase here that's helping us keep up with inflation. Again, another thing that we love about Social Security. It offers spousal and survivor benefits. It has delayed credits. If you don't take it right at retirement, it grows. And then tax advantages, we've talked about that. It's not fully taxable. There's really, outside of the HSA and the Roth in retirement, there is no other income stream like this that provides the same tax advantages, right? 401ks, pensions, IRAs, those are all fully taxable. Every dollar that comes out is taxed. Social Security is not that way. We love that. Okay. I'm actually going to skip this. There's $2.9 trillion in the trust fund as of the end of 2020. We feel really confident that's going to be there for you. If you're in your late, mid to late 50s, early 60s, here at Capita, we have high confidence that those dollars, those Social Security dollars are going to be there. We hear it all the time as advisors. I'm worried it's not going to be there. And when we hear that as a fear of retirees, a lot of times they make ill-advised decisions, because if you're worried you're not going to have it throughout retirement, what do? You file early, right? You try to get on that benefit as quick as you can, get as much out of the system as you can, but don't do that. don't just file because you're fearful of it going away. Make sure you talk to an advisor before you just file for Social Security. Okay.
Will it be there when you get there?
I highly doubt it. Yeah.
Oh, I actually think,
Really?
no, I'm
You-
kidding. No. I do.
I think
Hot
it'll be there
take.
for us. I just think we'll get means tested out of it. Those who are prepared for retirement won't get the benefit, but I think it'll be there. That's my call. I'm putting my.
So he says that,
I'm
and then I
drawing my
say
line.
it's going to be there. Won't be able to get it till maybe 70 or 75. I think it will move out, but
Yeah, they're going to push out those full retirement ages, right? For people on the call today, it's between 66 and 67. And realistically, it could be 70s by the time we get our full retirement benefit. So I could see that. And that's actually a good thing.
You mean by time we're means tested out of our full
Yeah.
retirement benefit? That's what you meant.
Just lower your income, Zach. That's all you have to do. All right.
Zach needs to spend more money.
All right, how are we doing here? Okay, 8 minutes. We're doing good.
Hey, it would be good to give us like at least 1 or 2 minutes on the last slide so that they can see like download slides and stuff like that.
Okay, perfect. So you're saying I have
So you
6
have
minutes?
less time.
Could you speed it up? Zach, let's chime in when we can.
Okay. The way that they calculate your benefit, they take your top 35 years of working income. Okay. They put that into an equation. Out comes what's called your PIA, primary insurance amount. That basically is just your full Social Security benefit at your full retirement age between 66 and 67. And then depending on what age you file for that benefit determines how much of it you get. So if you file early, which the earliest you can take Social Security is 62. If you're a widow or widower, you can take it earlier than that, but 62 for most of you on this call. If you take it early, you're going to get a lesser amount of the PIA. If you take it on time, you get the full amount. If you delay it past full retirement, you get a larger percentage of that. And I'll show that to you here in a minute, but you never under any circumstance want to delay past the age of 70. You need to be on your Social Security benefit by the age of 70. Here's your full retirement age. Find your birth year there to the left, and on the right-hand side, that's the age at which point you can file and have no consequences, right? If you file earlier than that, there's always consequences. Okay, let's talk about those consequences. So if you file early, 62 to 65, I'm going to focus on this middle column here. FRA stands for full retirement age. Assuming your full retirement age is 66 and you file early, let's say you file at 62, 3 consequences you need to be aware of. Number 1, you get a lesser amount. You only receive 75% of your benefit. Thus, if you have a $2,000 PIA, you're going to receive $1,500 a month. That penalty lasts the rest of your life. Okay, $1,500 a month for the rest of your life. Consequence number 2 is if you file at 62 and you decide, hey, I want to continue to work, that's fine. However, you're limited on how much you can earn. And that earnings limit for 2022 is $19,560. Every $2 over that amount that you earn, they're going to take back $1 of your Social Security benefit. So if you're working, making $30,000, $40,000, $50,000 a year, you file early, most likely they're going to take it all back from you because you're making too much money. Okay. And keep in mind, that's earned income only, W-2, 1099. This doesn't, like Laura mentioned earlier, it doesn't, pension income doesn't count towards that. If you have real estate or investment income, distributions from IRAs, none of that counts. It's literally earned income only. Okay. Third consequence, if you are the primary breadwinner, meaning within your household, you have the largest PIA or Social Security benefit, and you decide to file early for benefits, maybe at 62 and you get 75%. So you take that haircut and then you pass away, you're going to leave that reduced benefit to your surviving spouse. So they're going to lose, if you die, they're going to lose all of their benefit as the spouse. They're going to inherit yours, but now you've taken a haircut on yours because you filed early. So it's kind of like a double penalty, right? They lose their own benefit and then they take a haircut on yours for the rest of their life. So if you're the primary breadwinner, in most cases, this isn't always the case, because I think all of us in this room have advised specific retirees to say, no, take it early at 62 because of their specific situation. But in a lot of cases, we'll say, because you're the primary breadwinner, we might want to consider delaying that until your full retirement age. Of course, this is not a blanket statement for everybody, so make sure you talk to your advisor. Okay, if you delay past full retirement, or if you delay to full retirement age or delay past that. So once you're full retirement age, 66 in this case, you get 100% of your benefit. You can now work and earn as much as you want. That's a surprise to a lot of people. A lot of people think that earning limitation lasts forever. But once you're full retirement age, you can make as much as you want, $100,000, $200,000 a year, and collect your full Social Security. And then if you die, of course, you leave 100% of that benefit to your surviving spouse. Now, if you delay the benefit past full retirement age, there is a massive benefit here, and it's 8% increase per year on a lifetime stream of income that goes up with inflation, that's not fully taxable, and you get to leave it all to your surviving spouse. Okay. So again, before you just decide to file, make sure you work with a qualified advisor that understands this and can help you navigate the right strategy for you. And if you're married, for your spouse, and if you're divorced, consider your divorce situation. And if you have a spouse that's passed away, consider your widow situation, what benefits you may be entitled to there. Any comments on that, guys, before I move on?
No, I think the whole part of this is regret minimization. There's the cold math of it, but it's also making sure you're happy with whatever your decision is.
Yeah.
And a lot of it is, even if you think you've got a strategy, it's worth visiting the numbers just to see the math, because the last thing you want to do is get to your late 70s and you're like, somebody makes you aware of a benefit you could have had and the torment it will cause you. That's not worth it.
And how often do we come across that, right? Someone's filed before meeting with us and then they realize later, oh shoot, I made the wrong decision. And the problem, well, the consequence here is there are no do-overs on Social Security. You really get one shot at it. I mean, there's a way if you filed early or you filed wrong, you've got 1 year to fix that mistake. But after that, it's pretty much locked in. So you want to make sure to do it right the first time.
Tyler, if you had to, because of time, if you had to say, like, what is maybe the most important update or the most important thing you're talking to people in 2022 about, Social Security?
Yeah.
What would you say?
I would say the biggest update is the cost of living adjustment. I wouldn't say that was a surprise to us because we saw where the inflation numbers were landing. That COLA is based on CPI or how inflation's trending. And with inflation so high, we knew that it was going to be a high number. I don't know if we expected it to be 5.9. So that was a big boost to retirees and future retirees today. Other than that, I think the biggest takeaway, and we'll skip this spousal benefits, but I think that's making sure that you have a plan And that plan for every single retiree out there is so different because you're all unique. Some of you are married, some of you aren't, some of you are divorced, some of you have a widow or widower, and you've got to make sure that you understand all of the different complexities there and you file for that benefit.
Because I
properly.
flipped through those slides quickly, but if you were watching, there was survivor benefits, there were spousal benefits, there were, I mean, there was a lot that Tyler normally does, and we didn't give him enough time for it, but hey, we're still around, right? Yeah. I mean, we can answer.
You know how to get us, how to find us.
And the caveat to it is Social Security is not going to help you find a bigger benefit.
No,
they're not going to suggest an idea. And more times than not, I even had a lady that we were helping. She's a client. She had to do 3 separate calls because she was entitled to her deceased divorced spouse to get a spousal benefit. She had to talk to 3 separate people. I had to provide her with the documentations to be able to reference the part of Social Security for her to be able to get that benefit. Finally, the 3rd guy she got was like, yeah, no, this is easy. You're entitled to this. So we were able to get it. But my point in saying it is like, she like called me back, defeated 2 separate times. She's like, I talked to somebody and you lied to me. And it's like, I'm like, no, they don't know. They don't know what they're talking about.
So I've been watching. It does not look like we have any questions. We will stick around for a minute here. If you want to ask questions, then go ahead and do it. Notice up on the screen, there's a Scan Me QR code that has a landing page that all of these slides are on, and you'll be able to download those. It takes us about a week or so to get the video version of this up on YouTube, and then a link so you can watch it there. Obviously, if most of the people who want to watch it on YouTube are not with us tonight, so I don't know if that matters me bringing that up. Anything else?
I was like wondering how many people, like what topic did they enjoy the most? Is there a way to do like a short survey, like on the fly?
Type it in the chat, because it would take Laura and I too long to create the poll.
Never mind.
Maybe if you were part of the prep, Matt, maybe it would have.
So I would just say
Matt was very involved in the prep, everyone.
So
I'm sorry, I shouldn't have done that.
He slipped.
Who won the question? Yes, that's right.
Yeah,
I was making them all wait. Rand King got the last one.
Great job, Rand.
So we have Pauline, Robert, and Rand. We owe you $50 gift cards. We'll get them. I got your email from the polls, and we'll get those out to you. If you do have, I would love to hear. We would love to hear from you. Are these events helpful? If so, how? Is this format helpful? Are there other topics that we should focus on? Usually we can get 2 or 3 into an event. But anyway, if let us know what works. We're very open to making this for you. It's for you guys as clients. We appreciate it.
Something that I wanted to mention, we just had Tyler on our podcast and we went through this whole presentation in detail. That episode will be out in the next few months. So just be aware that will come out as well. If you feel like you missed out, you were here for Social Security and didn't get the full thing, that will be coming out soon.
Yeah, that's true.
It'll go trending.
No question. We feel like we missed out.
Listeners, it'll trend.
It'll trend.
All right, I'm going to play our little disclosure. We're going to sit around and we'll be here. Throw in questions in the chat if you want.
The opinions expressed in this program are for general informational purposes only and should not be considered as advice or a recommendation. Opinions expressed by guests do not necessarily reflect the opinion of Capita Financial Network. Past performance discussed is no guarantee of future results. Capita Financial Network does not provide tax or legal advice. If you have further questions, please contact your financial advisor.
Okay, hopefully you can hear me. If you're still around, Dennis, how do you get Social Security? How do you set up Social Security to take out federal taxes? You do a W, what was it? 4V. So you can Google that, W4V. They will withhold federal taxes. They will not withhold state taxes from your Social Security. So you could do it that way. Roger, that's a good question. We do these boot camps, about approximately quarterly, I think. Maybe it's semi-annual. It is semi-annual, I think. So, but Roger, that question of, is there a recession in the next 3 quarters? We'd need to talk about that sooner to answer that question in our next scheduled boot camp, right? But Roger, you'll get a kick out of that. I know, Roger. Anyway, we'll figure that out. That's a good one. Thanks for sharing. Anything else, Laura, that we need to clean up and answer in the chat?
I answered the chat questions.
Awesome. All right, we're going to hang up. Thanks, everybody.
Thanks.
This podcast is intended for informational purpose only and is not a substitute for personal advice from Capita. This is not a recommendation, offer, or solicitation to buy or sell any security. Past performance is not indicative of future results. There can be no assurance that investment objectives will be achieved. Different types of investments involve varying degrees of risk, including the loss of money invested. Therefore, it should not be assumed that future performance of any specific investment or investment strategy, including the investments or investment strategies recommended or proposed by Capita, will be profitable. Further, Capita does not provide legal or tax advice. Please consult with your legal or tax professional for advice prior to implementing any strategies discussed during this podcast. Certain of the information discussed during this podcast is based upon forward-looking statements, information, and opinions, including descriptions of anticipated market changes and expectations of future activity. Capita believes that such statements, information, and opinions are based upon reasonable estimates and assumptions. However, forward-looking statements, information, and opinions are inherently uncertain, and actual events or results may differ materially from those reflected in the forward-looking statements. Therefore, undue reliance should not be placed on such forward-looking statements, information, and opinions. Registration with the SEC does not imply a certain level of skill or training.